You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball, my co-host John McEwen. In this week's episode, we're going to be discussing IG Group, CMC, Experian, Rio Tinto, BHP Group, and Netflix. So, John, should I start us off with IG Group?
Yeah, so IG Group, it's the first company this week that we've got full year results for.
Yes, that's right. So I've had a look through the annual report. So for anyone who doesn't know, IG Group is the world's #1 spread betting and CFD provider. And that's based on revenue excluding FX. So they also provide, as well as spread betting and CFD, though, they do also provide stockbroking services as of 2014. So as you said, IG Group have released their full year results. So I've been through the annual report. I'll just go through the bits that I think are worth talking about. So I'll start with the income statement. Trading revenue was up from 448 million to 657 million. Net operating income was up from 477 million to 648 million. Operating costs were up from 282 million to 341 million. Operating profit was up from 192 million to 296 million. Earnings per share was up from 43.1p to 65.3p. I thought the numbers themselves looked very impressive. The growth was very impressive. I was very impressed with the margin. So they've got an operating profit margin of 45%, which I thought was very impressive. Going onto the balance sheet, I thought that looked like it was in good shape. There's not really much on there to be concerned about. Liabilities haven't really changed. Assets have obviously increased. It just looked like a pretty strong balance sheet, really. The cash flow statement I also thought was very impressive. The net cash generated from operating activities for the year was 292.5 million compared to 218.4 million last year. That's compared to a market cap of 2.91 billion. So it's basically trading at 10 times net cash from operating activities. I'll go to the CEO statement now and just read out a few bits. The CEO said, "I'm proud of the progress we've made since our strategy launch in May last year. The solid foundations and underlying growth we established in Q1 to Q3, in combination with the high market volatility in Q4, resulted in a record-breaking performance for the 2020 financial year. While we recognise that this period has been exceptional because of the impact of COVID-19 on our business, the underlying execution of our strategy shows that our focus on achieving sustainable growth and attractive shareholder returns remains firmly on track." She then went on to say, "COVID-19 triggered extraordinary trading volumes during months of unprecedented market volatility. We handled a sustained surge in trading flows and onboarded a large number of new clients, drawn to us by the investments we've made in our platform and our reputation for delivering the best service in testing circumstances. I commend all our people for their unwavering resilience, professionalism, and commitment to serving our clients across this challenging period." In May 2019, we announced our new strategy and 3-year growth plan. We set out medium-term targets to achieve an average annual growth rate of 3 to 5% per annum in our well-established core markets and to expand our business by an additional 100 million of revenue through a portfolio of growth initiatives described in our strategy report as significant opportunities. By the 2022 financial year, we remain confident in achieving these targets, and as previously set out, we're delivering a 43.2 pence per share dividend in the 2020 financial year. So that 43.2 pence per share dividend, by the way, that equates to a yield of about 5.49%, and the dividend's about the same as it was last year. The CEO also made comments about trying to expand into Asia, which has a very large trading market, and they gave some more information on that in their strategic progress report. So mostly established in the UK, but they've noted 3 specific markets they're trying to expand into, which are Japan, Greater China, and the US. So in Japan, they've said they've more than doubled their client base in a market with a £1 billion revenue opportunity. And they've noted that there's 2 million traders in Japan. In Greater China, they've opened a new Hong Kong office to establish a presence in the region. And they've moved forward with their plans to develop and grow their Greater China business. There's 4 million potential professional investors in Greater China, and that includes 500,000 potential professional investors in Hong Kong. And then they've also noted the US, where they've said that in the year they've been focused on the integration of their 3 US businesses, RFED, DailyFX, and Nadex. And they've reached over 27 million unique visitors globally with the DailyFX website in 2020. And they've noted that there's 705,000 futures and option traders in the US. In terms of the KPIs that they've listed, client income is up 49% year over year. And client income represents the gross revenue generated from their products and services before hedging activity, which is an important aspect of their business model. They've said that the conversion of client income to net trading revenue is at 67.7%, and that's actually down from 74% last year. So although the income's gone up, the conversion rate is down by 6.3%. And net trading revenue, the conversion to net trading revenue reflects the impact of hedging and their ability to monetize client trading flows. Net trading revenue itself is up 36% year over year. Net trading revenue from the core markets is up 29%, and net trading revenue from the markets they've defined as significant opportunities is up 85%. The operating profit margin is 45.5%, and that's up 5.2 percentage points from 40.4% last year. As I mentioned earlier, dividend per share is unchanged. Total number of active over-the-counter leveraged clients is up 36%. Net own funds generated from operations after investments is up 80%. They also gave a breakdown of their revenue, and the vast majority, so of their total revenue of 649 million, 617 million comes from OTC leveraged revenue, 18.4 million from exchange traded derivatives, and 13.6 million from stock trading and investments. So really the majority of the revenue is coming from OTC leveraged, even though they have started offering stock trading and investment services, they are a very small proportion of the revenue. In terms of the business itself, it's got a market cap of 2.91 billion, and that puts it at a PE ratio of 12.66. As mentioned earlier, the dividend yield is 5.49%. The share price, it's about £7.87 a share, and that's up 15% over the past 12 months, 35% for the past 2 years, 0.45% for the past 3 years, and 10.3% for the past 5 years. What are your thoughts on IG Group, John?
I think it's an exciting business, and the results this year have certainly been really outstanding. I suppose the questions would be, we've had a lot of volatility and trading has been very popular. Is that something that's likely to continue as we move out of COVID times? And also, is it a business that's going to be threatened by more regulation, certainly in terms of consumers? Because every time you hear these spread betting companies advertised, you hear the stat that, let's say, 80% or more than 80% of their retail customers lose money when they trade.
Oh, so I actually have that stat.
Oh, do you? Okay, what is it?
I assume it's for regulatory reasons, but they put it on the homepage of their website. So 75% of retail investor accounts lose money when trading spread bets and CFDs with IG Group.
Yeah. So that I suppose that's a question mark. And obviously, if those things didn't exist, it would probably be more expensive still. So it's not to say it's not priced in or anything like that. But yeah, I mean, I think it does look like an attractive business. What do you think of it?
I agree, it does look attractive. The only the current valuation, but one issue I had was if you look at the financials for the past 5 years, revenue has been very lumpy. So some years is up, some years it's not like it's moving in a consistent direction. So although they have had a fantastic year this year, if the past results are anything to go by, I would expect a decline in revenue next year. I don't think it'll be maintained based on the historic performance. So in that case, that although that PE ratio looks quite attractive now, if the earnings are going to come down significantly, you could easily, assuming the share price doesn't move, you could easily find it trading at a PE ratio of 20 in a year's time.
Yeah, exactly. And it does do well from volatility, and who knows what's going to happen, but you're not necessarily going to get that year after year. They did say they were trying to diversify a bit though and go into stocks, as sort of a stockbroking platform as well, rather than just sort of complex derivatives.
But that is a tiny proportion of the revenue. What do you think of the ethics of it?
Again, I think that's probably a bit more dubious because, I mean, we're a podcast on investing, but it is much more the trading, and you feel like just if you're watching, I don't know, if you watch YouTube videos, for example, I think they'll know that you're interested in investing, or even if you're watching sports, they'll try and promote probably to young men who may be interested or may sort of use gambling apps as well. There seems to be quite a lot of overlap between the two, so it's almost as though they're going a bit more into the gaming side of things rather than for people who might have the full knowledge and insight into what the risks they're actually taking.
Yeah, I do find the industry as a whole, or like the business, I find it quite distasteful. For me, I mean, I own a tobacco company, but I think this is worse because I think with a tobacco company, people are under no illusions, or certainly in this country, about the health impacts. Whereas with this, although they tell you on the website 75% of retail investors lose money, I think there's probably it's very easy to kid yourself into thinking that you're going to do well from it when you aren't, or you're almost certainly not. Whereas you don't really get smokers that have managed to persuade themselves that it's healthy. They just know the risks and they accept them.
And perhaps, with a gambling, sort of a gaming company, that's also quite clear. I mean, you do have the sort of psychological side of it that people get addicted to it, but this is maybe disguised a bit more or packaged a little bit differently to suggest that you can sort of outwit the system and you can sort of beat the market or beat the trades, which, I mean, as the stats show, it's very unlikely. It's probably one of those things you could lose an awful lot of money very quickly. And again, I can't say with IG Group, but I imagine you can probably get it on an app in your smartphone as well. So it's be there all the time. I mean, CMC Markets, not to go into detail about them, but it's a slightly smaller company. I think the market cap is close. It was about 1.25 billion.
Do you want to just go into that? Because that is our next company anyway.
Yeah. So it was founded by one of the Conservative Party co-treasurers, so Mr. Cruddas. He's a 67-year-old, and it's his family that have about 60% of the company's shares. Founded back in 1989 and started off as purely a forex market maker, and then it sort of moved into all sorts of spread betting, contracts for difference, and sort of basically allowing traders to make leverage wagers on different directions of equities, bonds, currencies, commodity prices. And CMC say that 79% of their retail customers lose money. In terms of the division, I think it's about 50-50. in terms of having the professionals and the retail investors using or retail traders, I should say, using their services. They reported that they'd enjoyed a strong quarter during the last 3 months to the end of December, although trading by clients had been at lower levels than earlier in the year at the peak of the first wave, which, a bit like IG Group, unsurprisingly. Full year net operating income is set to be at the upper end of the market expectations, following continued strong performance underpinned by high client income retention, which is well above 80%. And CMC said that in the third quarter, the entire business has continued to perform very well, with high active client numbers, resulting in strong client trading activity, although at lower levels than earlier in the financial year, which is sort of as outlined. And they expect annual net revenues at the upper end of the analysts' forecasts of the range from about 370 million to about 387 million. And another reason, particularly the share price of CMC did well in 2020, was that the dividend was increased significantly, and the final dividend went from what was 0.68p per share in 2019 up to 12.18 pence in 2020. And I mean, that's quite different to the rest of the market, and most of the companies that we saw, the more domestic focused ones, suspending the dividends, some of which have now reinstated them. It's also worth noting with CMC that it's more than just a spread better. It does act as a stockbroker in Australia and has about 17% of the stockbroking market there. So it's actually quite a significant player. Overall, it operates in 12 countries and has about 57,000 clients. More UK focused though. There is room for, I suppose, expansion in stockbroking in other countries and in the UK, but it is, a very competitive market, and the margins are there in the sort of the derivatives. I mean, that's where they make most of their money. So after the trading update, shares, they were more or less static, but the share price with CMC over the past 12 months is up about 176%. So it's performed very strongly. Are either of these companies or the industry something you'd be investing in then, Sam?
I can see the appeal. The profit margins are very nice, but from a pure, in terms of looking at the business standpoint, the fact that the revenue is fairly lumpy is maybe something that puts me off a bit. And then also I do find the products quite distasteful. So probably not, to be honest. I don't think I'd really be interested at any price.
Yeah, no. I'd probably say I'm largely the same, and for similar reasons as well. But they're certainly interesting, and you see them advertised. You see them everywhere now.
Yeah, and it doesn't mean you couldn't invest and do very well in it either.
Oh no, you may well invest and do very well. I mean, I think that's going forward, despite things being lumpy and potential for future regulation. It's they do look set potentially to do very well going forward.
Did you have a preference between the two?
No.
Fair enough.
Do you have a preference?
Probably would have gone with IG Group just because the dividend yield's a bit higher.
Yeah.
So it's over 5% compared to 3.8% for CMC Markets, but they are very similar.
They're very. What was our next one?
Experian.
Okay.
Experian. So they've come out with a Q3 trading statement. So for anyone who doesn't know, Experian is a global technology company, and they provide data and analytics solutions. Their business-to-business data side of the business helps businesses to identify and understand their customers, to manage the risks associated with lending and lend responsibly. And their consumer services side of the business helps consumers to take control of their financial lives, manage their financial position, access credit offers, and protect themselves from identity fraud. They also provide digital identity resolution for marketers that helps connect brands to consumers. They operate across 4 regions with offices in approximately 45 countries. So they've come out with a Q3 trading statement, and they've reported organic revenue growth of 7% and total revenue growth of 10% in the third quarter. And they said that reflects good results in the Americas, especially in the consumer business, which is ahead of management expectations. They said they now expect fourth quarter revenue growth of 3 to 5%, with full year operating profit of $1.36 billion to $1.38 billion. So they said for the North America segment, their organic revenue rose 9% in the third quarter, business-to-business revenue up 6%, and consumer services up 18%. Total revenue rose 11% following the acquisition of Tapad in November. They said strength in mortgage volumes and analytics platforms, and their analytics platform Ascend more than offset weaknesses in unsecured lending and marketing data. Revenue in Latin America rose 13% on both an organic and reported basis. Business-to-business revenue rose 2% despite lower credit bureau volumes as Ascend and automotive performed well. Consumer revenues rose 178%, with Brazilian free memberships hitting 56 million. Said for the UK and Ireland, sales fell 2%. However, that's a significant improvement in the first and second quarters when sales fell 15% and 8% respectively. Said in the emerging markets in Asia Pacific, it's Experian's smallest division, accounting for 8% of group revenues, and that saw organic sales fall 11%, although overall total sales rose 16%, thanks to the acquisition of Arvato Financial Solutions. In terms of the valuation, they're currently trading at a PE ratio of 32, and that compares to a 10-year average of 20.9, and they've got a prospective dividend yield over the next 12 months of 1.4%. The company has a market cap of 24.18 billion, and looking at the financials for the past 5 years, and these figures are in dollars, revenues increased from 4.237 billion to 5.179 billion, and earnings per share is basically flat at about 75 cents a share. Share price is currently trading at about £26 a share, and that's pretty much flat for the past 12 months. Over the past 5 years, it's up 134%. Over the past 3 years, 59%, and over the past 2 years, 35%. John, thoughts on Experian?
It seems like a quality business, and it's in an area that's certainly growing. It's the UK's leader in the field, with a very decent decent size in terms of market cap too. So I suppose a business with high barriers to entry as well. Perhaps for the price, they're not growing the revenues as rapidly as they might be. But to me, it seems like a quality business that I would be interested in looking into further. Okay. What do you think of it?
I thought the business itself, I agreed, looked quite good, but I do agree with what you said about I'd expect it to be growing more. And the dividend yield's not particularly good either. So if it's not growing and it's not giving a good income, I think really the price would probably need to come down before I considered it.
Yeah. Is it an industry that you'd consider? You know, like Equifax being the bigger one over in the US?
No, I like the business itself. Yeah, it's definitely something at a price that I would be interested in.
Yeah.
20%. And what was it? It was like 20% over the past 5 years, and none of it gone through to earnings, which I thought was quite poor. They have given an adjusted earnings per share, which has increased over that time period, but I don't really like adjusted earnings per share because you could adjust for whatever you wanted, couldn't you?
Yeah. I suppose if you look at revenue from 2007 to 2020, that's grown at an average annual rate of 8.1%.
But then it has slowed as it's got bigger.
Yeah.
Those last 5 years, it's only just over 20%.
Yeah, no, that is true. I suppose it's something that could always be, if you had a data breach, a bit like Equifax in 2017, that could really undermine the business. And it's something when it is that's the industry that it's in is always going to be a target for hackers. I'm sure they do have very good, security systems and things in place, but in that industry, it's a risk.
It's a honeypot. That's what they call them, isn't it?
Is that what they call them?
Yeah, they're called honeypots, where they've got so much data there that it's just a really attractive target for hackers because I mean, with like
Yeah.
Experian, what was it, like 70 million people's financial data? Like,
Yeah,
if you were a
yeah,
hacker
yeah,
and you
yeah.
got your hands of that, it's just the ultimate prize, isn't it, really?
Yeah. And how much that would be worth on the sort of
Yeah.
dark web or whatever. Yeah.
Anyway, we've gone on a tangent.
Yeah. Okay. So Experian, one to consider. One to
Potentially.
watch.
It's not
Yeah.
one I'd rule out. That's probably, I'd definitely
Yeah.
revisit it.
Yeah, and it's certainly, I mean, going off on sort of consumer finance tangent, it's probably quite useful to use and to look up your credit rating, because they'll, other than selling you products, there are very useful tips on how you can increase your credit rating, which is something that's always useful.
Right, so should we move on to the miners next then?
Okay, we've got two this week, which includes BHP Group and Rio Tinto. BHP being the world's largest miner, and Rio Tinto somewhere behind it.
Oh, so Rio Tinto's got a market cap of £73 billion compared to 106 billion for BHP. So it's about three quarters of the size.
So BHP Group, BHP said that it produced a strong operational performance in the first half, but it would take a charge of up to $1.25 billion or 910 million pounds on its coal operation in New South Wales. The FTSE 100 miner said copper equivalent production was broadly flat in the 6 months to the end of December, as good operational activity offset planned maintenance, field and copper grade decline, and bad weather. The company achieved record production at Western Australia iron ore and an average concentrator throughput at Escondida mine in Chile. Record average, sorry. Annual unit cost guidance for the group is unchanged. BHP said results for the first half would include an impairment charge of 1.15 to 1.25 after tax, that's $1 billion after tax, related to its New South Wales energy coal operation. The company said that exceptional charge reflected the market conditions for Australian thermal coal, the stronger Australian dollar, changes to the mine plan, and a reassessment of potential tax loss recoveries. Chief Executive Mike Henry said BHP delivered a strong safety and operational performance in the first half of 2021 financial year, including record production of the Western Australian iron ore and the concentrator throughput at Escondida. We are well positioned to sustainably grow shareholder and social value as the global economy recovers from the pandemic. And the shares were up about 1.5% on the day to £21.42, and the company's shares have gained more than 40% since late October, as investors have bet that mining companies would boom on the world economy as the world economy recovers from COVID-19. You also have the US saying with the election of Joe Biden that they're going to be investing a lot in the infrastructure. So you've got that too. In terms of Rio Tinto, they reported on Tuesday that a 2.4% rise in the fourth quarter in iron ore shipments boosted a return to the pre-pandemic industrial activity in China. The company said the world's second largest iron ore miner shipped 88.9 million tons of the product in the 3 months to the December the 31st, up from 86.8 million tons a year earlier. It expects to ship between 325 to 340 million tons this year, compared with 331 million tons in 2020. They said, in China, the industrial sector has recovered and is now at pre-COVID levels due to the rapid deployment of stimulus. Iron ore prices rose significantly in the second half of 2020 on the back of tightened market fundamentals. China's buying remains robust despite ongoing localized impacts from the COVID-19 in some regions. Demand in Japan, Korea, Taiwan, and Europe is recovering. Copper output fell 9% to 527,900 tons due to lower grades at its US Kennecott mine in Utah and production phasing at the Oyu Tolgoi,
maybe?
At their Mongolian mine.
That's an easy way out.
The company had earlier projected annual mined copper output at 475 to 520,000 tons, adding that it would expect to produce between 500,000 and 550,000 tons in 2021. So I suppose both miners look to be benefiting by increasing prices of the raw materials and also a return to sort of global growth. Depending on what your view is on the outlook for the next year, if you are bullish on it, then the miners certainly could be a place to invest. But they are, as always, very cyclical, And if there's a global recession, the miners are the first to drop. Did you have any thoughts on either Rio Tinto, BHP, or any of the other the mining industry in general, Sam?
No, I agree with what you said. I mean, it does look like quite good numbers from both of them in terms of they are producing good amounts. It looks like they are benefiting from the rise in iron ore prices. The PE ratios look quite attractive. It looks like Rio Tinto's at about 13 and BHP Group's at about 16. Rio Tinto's yielding at just over 5%. BHP Group's yielding about 3%. But like you say, you would expect those PE ratios to compress as prices go up, because obviously investors are aware that they are cyclical. But I guess it depends on what you think the longer term trend is going to be for iron ore and other commodity prices, which my issue would be that I'm not particularly knowledgeable about that. So it possibly goes in the too hard pile.
Yeah, no, I think that's probably a fair comment.
I can see the appeal though.
Yeah.
If you do maybe know a bit more about the individual commodities, because the two are linked, aren't they? You couldn't get to know the business without understanding the commodities they're actually selling, because the business could do everything right, and if the price of the commodity moves against them, they could still have a terrible year.
That's right. And I suppose it depends how well run they are, and arguably they were a bit like the banking sector and the house builders. Prior to 2008, they were over leveraged and not in a good position to withstand a downturn. Arguably, with these two, they're much healthier businesses than they were back in 2000, or just before the last financial crisis. But the same problem does apply, that if the commodity prices drop and there is sort of a downturn which leads to that, there's not much these businesses can do about it.
Well, yeah, I suppose you could leave it in the ground, but it's not a great position to be in, is it?
It's not. And I think certainly with BHP, that is a company that I held only a very short period of time back in 2016. I think I bought in at about £8, £7 or £8 a share, and it was before Donald Trump was elected, and he certainly announced a big infrastructure splurge, and I sold on the news of that essentially at about £13.50. But it wasn't a company that I'd really done my own research into. It was a stockbroker that I had at the time had recommended it. So I'd sort of gone along with that. But I tend to agree with you at the moment. For me, if I was looking at it individually on my own, I'd probably put it in the too hard pile.
But would you even need to look at it though from just looking at your portfolio, because you've got that commodity exposure anyway, because it's so heavily linked to the iron ore price, you'd have benefited from that inside your commodities index.
You would have done, but I suppose I'd have to check the commodities index to see what percentage applies. But yeah, you would have broadly benefited from that. You are right there.
Should we move on to our American company?
Yes. So Netflix.
Yes. So Netflix, who are, for anyone who doesn't know, the online streaming platform, they have released a Q4 trading statement. And they've said that they added 8.5 million net new paid subscribers in the fourth quarter, which beat management expectations of 6 million. And that compares to 8.8 million net new subscribers this time last year. Although that is a bit of an unfair comparison, because they did announce earlier in the year that because of the pandemic, they had a huge influx of new subscribers. And they said what they thought it had done is it had pulled forward a lot of subscribers from the third and fourth quarter. So the fact that it is so close to the fourth quarter last year is actually very, very good. So that decrease doesn't really mean anything, just because I think, like management said, they were actually expecting 6 million compared to 8.8 million last year. So to get 8.5 is very good. They said operating income was $954 million, and that was more than double last year. For 2021, they've announced they expect cash flow to break even, which is at the top end of previous guidance of between a $1 billion cash loss and break even, or cash outflow and break even. Combined with their available cash, they've said, we believe we no longer have a need to raise external financing for our day-to-day operations. I think they also announced they were going to be looking into doing some share buybacks. So for the full year total, they've announced net new subscribers were 37 million, and that compared to 28 million in 2019. And 83% of the paid net additional subscribers came from outside of the US and Canada. Average revenue per membership was flat in Q4, with modest growth in North and Latin America, while other regions were flat. Despite this, overall revenue came in slightly better than forecast at 6.6 billion, which was up 21.5%. Operating margins improved 6 percentage points to 14.4%, which was better than expected and driven by the higher revenue. For the year as a whole, operating margins rose 5 percentage points to 18%. For the 2021 financial year, the group's now targeting operating margins of 20%, which is 1 percentage point higher than previous guidance. Marketing spending was 13.2% lower than Q4 in 2019, and general admin costs were up just over 8%. We spent 3.3 billion on new content compared to 3.9 billion a year before, and that's dollars. And the full year content spend was 11.8 billion compared to 13.9 billion a year before. Free cash flow for the quarter was negative 284 million compared to 1.7 billion in Q4 2019, bringing full year free cash flow to positive 1.9 billion compared with a 3.3 billion outflow in 2019. At the end of the year, Netflix had net debt of 8.1 billion with undrawn credit of 750 million and 8.2 million of cash and cash equivalents. In terms of the valuation, they are trading at a 12-month forward PE ratio of 53.8, and that compares to a 10-year average of 132.9. Their prospective dividend yield is nothing, and they are trading at a market cap of $249 billion. Thoughts on Netflix, John?
It's very expensive. I mean, it's impressive that they've, valuation aside, the operating profit increasing from 2.6 to 4.59 billion, and the growth in the paid subscribers. But at that price, how much do you pay for this business? That's the bigger question, really. But it's certainly a company that I wouldn't bet against. They're getting more efficient and more profitable. The original content is certainly improving, and I think that was probably an issue for them a few years ago, but now they have some really great series which they produced themselves, and the business is looking to get into sort of a more sustainable shape, would you say?
Yeah, I can see both arguments for like the bull and the bear case. I think if I was trying to make the bear case, I'd say, this year has obviously been a fantastic year, but they've been able to cut back on advertising, marketing. They've had lower production costs because they've been locked down for a while. So they've just been releasing the back catalogue or like the stuff that was had already completed. And that's meant that the costs have come down. And on top of that, they've had this year where they've just had loads of people coming to Netflix because of the pandemic. So revenue is up. And you could argue, would they be able to sustain that? Because next year they need to get the catalogue back up, because previously they had about 2 years of like content already filmed, or like a year or something already in the back, like just ready to go, and they were releasing it over time. And they need to build that back up. They're obviously they're gonna have to start marketing and advertising again, so the costs are potentially going to go up. So I think on the bear argument, you'd say, and then there's also the issue that if they can keep adding new subscribers, and then that's great, but if they have to keep increasing the content spend proportionally, then will they ever get to that profitability that's priced in? Mm-hmm. It is an issue that some people talk about it as if once you've made enough content, it's there, but this content does depreciate. Like in 20 years, people won't want to watch a lot of the stuff that's on there now. So they do need to constantly be producing new stuff.
Yeah, no, absolutely. And Disney Plus has now come into the market, which is certainly going to be a competitor for Netflix. That's not to say it's one or the other. You could absolutely have both subscriptions.
No, but I think one thing it does do is previously they've always increased the prices year over year, and they've increased them again this year, actually. But there could come a point where they can't increase prices anymore either. And there could come a point where they reach saturation, because they've got over 200 million subscribers now, and I don't know what the upper end of that is. Maybe they could get to 1 billion. I don't know. But on the bull side, I think you would say, well, if they can just get to a point where they're active in so many countries now, that if they can get to the point where they're making enough content, that will at some point stop increasing. And although they have to spend it every year, it's going to stay at a fairly constant level. And then any new subscribers they're adding on are just going straight to the bottom line. And they maybe don't need to add on that many new subscribers before that PE ratio starts to come down, all other things being equal. So I think really it comes down to firstly how many subscribers you think they can have, and whether or not you think costs increase proportionately with the subscribers. And then there's also potentially the issue of churn as well. But I see both sides, and I'm probably where you are, where I wouldn't bet against it. I think if I held it, I don't think I'd sell it. I think I would. No, I wouldn't sell it. Yeah. But I do think that I probably wouldn't want to be getting into it at this price, though.
Yeah, you'd be quite brave.
Yeah, I just think so much of the growth has already happened now, and there's so much still priced in compared to the valuation. I mean, it's a $250 billion company now, and how high do you think it can go? Do you think maybe it could be $1 trillion company? Maybe it'll be 500 billion. I don't really know, but I don't know. I think if you'd recognised the potential for it 3 to 5 years ago, or however long ago, then you've obviously done incredibly well. But yeah, it's not something I'd be jumping into now. But no, I do feel like you do. I certainly wouldn't bet against it.
Yeah, that's right.
Of the 6 companies we've talked about today, IG Group, CMC Markets, Experian, Netflix, Rio Tinto, and BHP Group. If you had to buy one, which one would it be?
It's a good question. If I were to buy it to hold for the very long term, I would probably actually go for Experian, I think.
I don't know which one I'd go for.
I'd see potential. I see potential for Experian. I think it can do better going forward. I appreciate it's not that cheap, but it's certainly not as expensive as Netflix, and it's probably not going to be as cyclical as the miners. And we mentioned the ethical reasons for not potentially not going for CMC Markets and IG Group. That would sort of leave me with Experian, and it's a business that I think going forward can do very well.
See, I'm similar to you. I wouldn't particularly want miners, mainly just because of a lack of understanding. I wouldn't really want the spread betters. So I'm stuck with Experian or Netflix. And I think I'd probably actually go with Netflix.
Okay. That's not to say I wouldn't like Netflix, but I'd, on balance, it'd probably be Experian.
Yeah. I mean, I won't be adding any of them.
No.
So we've also got a listener question. So I'll read out. So it's from William, and he sent 2 tweets in. First one was, discovered your podcast just before Christmas and think it's great. If you could keep up with my consumption rate of 4 or 5 episodes a week, that would be great. So we'll see.
We'd have to give up the day jobs.
We would, yeah. Or one of us could give up the day jobs. And then, well, maybe once post-pandemic, you might not be as busy anyway.
All right, okay. And what was the second question?
So the question was, it's been great to learn so much from you, but I was wondering if you could talk about a couple of things. When would you stop beating a dead horse and sell? I bought Neil Woodsford's fund when it IPO'd. And are we better to sit on cash right now in anticipation of a correction? Do you want to have a go at it first?
So when to sell, I think it's not easy. It's never easy to decide. If you were to boil it down to the basics, I think you'd probably sell if you thought that the fundamentals of the business had changed, or something fundamental about the business had changed. And that was either causing issues for you individually or for the profitability of the business going forward. That would probably be one reason to sell. You might say if there was a change to, if there was an accounting scandal or you couldn't trust what the company was saying anymore, that could be, another reason. But I think it would really be the fundamentals, if something in the fundamentals of the business were to change for the worse, then that might be the point at which you sell. It's difficult now with, I suppose, some of the tech companies that might have very toppy valuations. But I would say if you think they're quality businesses and you've been holding them for a long period, which is what you should do, then there would be no reason that you had to take profits or anything like that. And I suppose with some of these very successful sort of Silicon Valley or people who have invested in companies from Silicon Valley, it's never going to be, oh, well, they want to make, 100%. You've got to hold those quality businesses for a very long period. And that's when you sort of get your 10 or your 20 baggers. So there's certainly no reason in terms of valuation with companies that you've held for a long time, if they have grown a lot, as long as the fundamentals were still going in the right direction. And what was the second part, Sam?
Are we better to sit on cash right now in anticipation of a correction?
Okay, so in terms of sitting on cash, I think it's, in my book, it's always better to be timing the market than trying to time the market. It's very unlikely that you'll be successful with timing the market. And if you get it right once, you probably won't get it right a second, third, fourth time. So I would say it's better probably just to drip it in. So say you had, let's say £10,000, you might want to drip that in equally over the period of a year. Depends what you're investing in as well. If you're investing in a single company, maybe you would just put a larger amount in to start with if you thought the price was right. If it's an index, then I think dollar cost averaging is even more sensible, really. And that way you do reduce the volatility, not the risk, but the volatility. So that would probably be my take on it. What are your thoughts, Sam?
I agree with a lot of what you said. So in terms of selling, I think I've said pretty much the same thing. I think you'd only really sell if something about your underlying thesis of why you bought and changed. So the example he gave was that he bought Neil Woodford's fund when it IPO'd. Now, Neil Woodford has had quite the fall from grace, so I don't think he's managing that anymore. So if you've bought it for Neil Woodford's management and he's no longer managing it, then that potentially is a change in your underlying thesis. So that could be a reason to sell. But I agree with what you said in terms of I'd be very hesitant to sell because of valuation, even if in hindsight it turns out you should have done, just because I think if you are able to identify a great business and it does perform very well, as long as the business is continuing to deliver for you, I don't think you should sell because of valuation. I think you should only really sell because your underlying thesis has changed, or if you need the money for something that you think will do even better. So I guess there's an opportunity cost element as well. In terms of sitting on cash in anticipation of a correction, there is some element of personal preference, I guess. So I do know one person that likes to sit on quite a lot of cash, and that he feels a lot more comfortable doing that, even if it might statistically lower his returns over a longer time period. Personally, I don't really like to sit on a lot of cash. I suppose what I do really is I've got a monthly amount that goes into my portfolio, and when I see something that I like, I buy it. So sometimes cash builds up because I've not seen anything I like for a while, and sometimes I'm waiting for the cash to come in because I know exactly what I want to buy when it arrives. But I wouldn't ever really want to keep a significant cash balance, just because you are getting a negative real return on that cash because it's being inflated away. So my view is I'd always just rather put it to work, even if it means I end up buying at the top of the market sometimes. But like you said, if you're investing monthly or however periodically, sometimes you're going to buy when things are expensive, and sometimes you're going to buy when they're cheap. But overall, you should do fairly well.
Yeah, and it's not to say you couldn't have a bit of a war chest if there happened to be a correction, but I think you're likely to do better in the long term if you're invested in the market for longer, which means that you're not going to be sitting on the sidelines trying to time things.
I guess if having a significant cash balance allows you to feel better about the stocks you're actually holding, then there probably is a benefit to it. So it depends on your own psychology as well, I think.
Yeah, and it probably also depends on your age. The older you are, perhaps
Yeah.
the less cash you'd want, the more cash you'd want to be sitting on, and the younger you are, you might want to have more exposure to the markets. So because you've got more time to recover from a potential loss and have longer time to benefit from the growth of the market.
Yeah, so if you're retired, you might want a few years worth of cash in the portfolio, just because then if there's a downturn, you can ride it out and keep drawing the same amount that you need without having to sell anything.
Yeah.
Whereas if you're 20 and you're not going to be retiring for 40 or 45 years or whatever it'll be, soon as it keeps going up, then you could make an argument for not having any cash.
Yeah,
providing
and
you're comfortable with it.
You don't want to be in the position where you're a forced seller either. So you want to have enough cash to be able to tide you over a bit, like you say, Sam. Otherwise, you wouldn't want to be in a position where you were forced to sell your stocks to raise cash.
Yeah, I would add as well that in terms of my owning, I'm talking about cash in my portfolio, and that is not the same thing as cash in my bank.
No, sure, but I mean, just in general terms.
Yeah. All right, so I think that's everything. Unless there's anything else you want to talk about.
No, John? I think we've covered most things.
All right. Well, see you next week then.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.